I'm going to leave it all on. For some reason, the 75% looks like this. But at least it's not cold, right? So how was the break? Good to have a long weekend, right? And actually next week we have no class on Wednesday because it's a holiday as well. So next week we have only one class, Monday. But I've reminded you enough, but I'll remind you again that the first quiz is at the start of class on Monday. So let me very quickly review the rules of the quiz. For those of you in my corporate finance class, you kind of know it. But I want to make sure everybody kind of understands how this works. It'll be in the first 30 minutes of class, not the middle 30 minutes, not the last 30 minutes. So if you come in 20 minutes late, it's over already, right? First 30 minutes of class, there'll be 2 rooms. I'll email you the 2 rooms and I'll let you know which last names go with which room. So I want to spread it out so you have more room to kind of do your quiz. There will be class after the quiz. So if you're doing it in the other room, make sure you come back here because we'll have about 50 minutes of class still after the quiz. That's the first thing. The second is, if you're not going to make the quiz, somebody remind me again what the rule is. What do you have to do? You have to let me know before the quiz, not in the middle of the quiz, not at the end of the quiz, but before the quiz. So even if it's 10:28, 10:27, 10:26, you got to let me know. It could be, and you know what, you're grown-ups, I'm grown-ups, I hope. So if you tell me you have a good reason, I'll take you at your word. I don't need to see doctor's notes or your mother's, don't have to write to me saying my kid is in trouble, that's why. So if you tell me I really cannot do it, I will take you at your word that you have a good reason. There's a cost you bear, right? And what's the cost? The 10% will get moved to the remaining quizzes in the final, but you lose that option of your worst quiz, that freebie that you get, right? So in a sense, if you're not fully prepared, if you're not quite ready, it's still better to take the quiz than not take the quiz, because if by some chance you happen to know those 3 questions just accidentally and you get a 9, so don't not show up the quizzes because you feel only 80%. If you're 0% prepared, then I'm not sure what you can do. But if you're prepared enough that you think you can take the quiz, my suggestion is that you take the quiz. So let me know that if you're not going to take the quiz so I can move that 10% to your remaining quizzes in the final. Third, in corporate finance, we had a review session for the quiz. On this one, I don't usually have a review session because I think you're ready to do this on your own, but I will give you a little helping hand. I did a webcast review session for this class. It's an hour-long review session, just like I'll put the links up to the webcast review session so you can watch it sometime between now. So it's just like a corporate finance review session. It's just recorded for time. So basically, so it's an hour review session. So I'll send you that link after class. Finally, many of you email me asking, where is the valuation of the week this week? Not a single person asked me, where's the valuation? So, So I can see that you're waiting on tenterhooks every Tuesday for this week's valuation of the week. And it's coming. It's coming. It's actually, I think that this is actually the most current of the valuations, because I just finished my valuation of Deutsche Bank, and that's going to be the valuation of the week this week. I was just finishing the story, and that's what was taken, because the story is like a horror story, right? You don't know where to land, in the Hall of Mirrors, or you're going to be in a cemetery somewhere. So I'm telling the story that so I'll send that link out after class today. So it'll be this week's valuation of the week. Obviously, given that you have the quiz, it's not something that should be up on top of your list. But this is a company we're reading about that's at the center of what markets are doing right now. And actually what I've done is built a spreadsheet where you can go and adapt the numbers. I mean, one of the things, for instance, and we'll talk about this today, is what triggered this particular episode of crisis in Deutsche Bank was what? A news story of that? I mean, they've been in trouble for a couple of years. They've lost 16 billion the last 2 years, but it's like a slow motion car wreck, right? And it looked like they turned the corner a little bit because they had profits in the first 2 quarters. But what triggered this particular bunch of hand wringing? What was the news story that caused it? You guys haven't been reading the news, have you? Yeah. The Department of Justice has fined them $14 billion. You're saying, what's the big deal? Banks are thinly, the equity in a bank is a thin slice of the bank. So you might be a $4 trillion bank in terms of what's on your balance sheet, but $14 billion is about 1/4 of the regulatory capital. So that's going to be a big chunk out, and that's what's triggering all this angst is, what will they do now? So in the spreadsheet, actually, I give you those choices of how much that fine will be. So you can do the 14 billion saying that's a fine, they have to pay it. Deutsche has countered with a $6 billion reassessment of what they think. And if you look at the history, Deutsche is not the first bank that's been fined from the 2008 crisis. The actual numbers turned out to be lower than the initial DOJ number by 50%, 30%. So I actually ended up using 10 billion in my valuation as the fine. So in the spreadsheet, I actually let you decide. So you can go in and pick those items. I think the fine will be 14, 10, 6, see how it plays out in the valuation. In fact, I gave you a start of the class test. I'm actually going to use the Deutsche example to kind of illustrate, or use it as my start of the class test. You don't have the numbers in front of you, but these are broad conceptual questions. How many of you are doing money-losing companies? Okay. Should be at least 1 of every 5 or 6, right? So if you don't know it yet, you have to do a money-losing company, one person in each group. One of the ways in which people deal with money-losing companies, we'll talk about this today, is to normalize earnings. Sounds fancy, but what they do is they take the average earnings across time, and they use that instead of this year's earnings. Lots of people say that's the way. So I'm going to kind of list out assumptions I need to make for this to be okay, and you tell me which of these assumptions I need. First is this is going to work only if your company has a history of making profits, and it's just lost money this year, right? That assumption, because if you have a company that's been losing money all its life, averaging earnings is not going to get you there. So that assumption is needed. Second, I have to assume that whatever cost you lost this year is a temporary loss, a fine, a strike, because then once that problem goes away, so the problem is transitional, so transitory, so once it goes away, so that's the second assumption I need, right? So I have to assume that the company historically has made money, that the loss is coming from a one-time something that's going to go away. Third, that the business itself has not changed in some deep structural way. So if I'm a taxi cab company, I'm losing money this year. I can't take the earnings for the last 10 years because ride-sharing companies have taken away 1/3 of my profits. Fourth, the company couldn't have scaled up or scaled down. You know what I mean by that? If the company's grown tenfold over the last 10 years, using the average earnings over the last 5 or 10 years is going to give you a misleading picture because you have a much bigger company now. I mean, so if you think about it, I need all of those assumptions when I normalize earnings. Deutsche lost about $8 billion in the last 12 months. So here's my question. It's a very pragmatic question. Could I have just normalized earnings for Deutsche by taking their earnings over the last 20 years? In other words, what's the question I'm asking? Are the assumptions I just listed going to hold for Deutsche? It's historically made money pre-2008, right? Post-2008, it's been up and down but if I go back long enough, I'll get positive profits. But if I go back long enough, what's the risk I'm going to be running? Do you think the banking business has changed? It's especially since 2008, seismic shifts underneath, right? The risk in the business has changed, the profitability of the business has changed. So you can already see with Deutsche, I could not use that strategy. Let me just assume bouncing back, because bouncing back to the past is really not going to happen. And in fact, that's the first page today. One-time losses, when can I get away with it? You can get away with just taking it out if you truly believe it's transitory. So if their loss had been caused entirely by a fine, I could have just said, okay, what would the earnings be without the fine? Let's assume they bounce back. But their loss last year was not because of the fine, but because of loans they made to Greek companies or Italian companies. I mean, they have other problems. Those problems are deeper structural problems. So normalizing is going to be tough to do with Deutsche. So when you look at the valuation, you'll notice I don't normalize. So you'll have to wait to see what I had to do to get their negative earnings to positive earnings, because otherwise the whole thing is going to fall apart. Here's the second thing. I've assumed a $10 billion fine, right? So that's going to lower the regulatory capital. It's going to lower it to about 12.5%. The Tier 1 capital is going to drop to about 12.5%. 12.5% is not crisis level, but it's close to crisis level. They have a regulatory capital problem. So if they want to go back to being a healthy bank, they will have to raise their regulatory capital in the next few years. So in my spreadsheet, when I value Deutsche, you'll see me trying to get them out of the problem by first assuming that earnings recover and simultaneously assuming that they're going to have to put money back into regulatory capital to get back to some reasonable health of the regulatory capital. You're saying, so what? You know what my cash flows look like for the first few years for Deutsche? I have losses that they're still coming out of. So the losses don't turn to profits automatically. It takes about 2 or 3 years. On top of that, they'll have to issue about $20 billion worth of fresh capital. So that's like a cash outflow. I have negative cash flows for the first 3 years of about $20 billion. I have a question for you, because when we do this in discounted cash flow valuation, we often don't even think about what it means when you get negative cash flows in year 1, year 2, year 3, year 4. I am implicitly assuming that Deutsche is going to be able to raise equity to cover this deficit. And we do this routinely in DCF. We act like if we have negative cash flows, not a big deal, go out and raise capital. But could that get us into trouble? Is that potentially a dangerous assumption to make across the board? What's the question I'm asking? Is it possible that you have negative cash flows and not be able to raise capital? Absolutely. And if that happens, if you're not able to raise capital, what happens to the company? The game is over. What does that mean? Remember all nirvana waiting for you in year 10, big terminal value? There is no nirvana. You're not going to get there. Discounted cash flow valuation is built on the premise of a going concern, and that going concern assumption requires you to be able to raise capital. So one of the things in the Deutsche valuation is I have these negative free cash flow to equity. I'm assuming that they're going to be able to raise equity to cover that deficit. But I do think even with a company the size of Deutsche, there is a chance that they might not be able to access capital markets. In which case, what's going to happen? Deutsche can't be shut down. It's a bank. I mean, the runs you would get on, across the board. So here the German government will have to step in. You'll get a bailout. You're saying this is good. But as an equity investor, remember, a bailout will rescue the company. There'll be a Deutsche Bank the day after the bailout, but your equity will go to 0. So in my valuation of Deutsche, and you're going to see this, I've attached a 10% probability to what I call a catastrophic risk. And the equity value is going to go to 0. So if you get a chance, visit the DCF valuation, because you're going to see, because these are fundamental issues we tend to take for granted. And with Deutsche, I couldn't take them for granted. They were staring me in the face saying, what are you going to do about me? I didn't do a dividend. I see people doing dividend discount models on Deutsche still. I don't know what dividends they're discounting. There are no dividends as far as the eye can see. This is a bank teetering on the edge of disaster. you're not going to get expected dividends to discount. So those two issues I want to talk about it in the context of cash flows. As I said, let's start with the one-time charges. So we're on slide 129. Let's assume you're valuing a company. It has a loss of $500 million. That's what the bottom line says. But there's $1 billion one-time charge. And it's truly one time. It's because there was a strike last year. And because there was a strike last year for 4 months, the production capacity had to shut down. Huge loss. But it's a one-time loss. If it's truly a one-time loss, if you're valuing the company, you can see what you're going to do, right? If it's truly one time, it happened last year, it's over. When you're making a projection for the future, you can act like the profit for the company is $500 million. So this is often what we do with extraordinary charges with companies. We act like they're extraordinary, and because they're extraordinary, we can ignore them. So for many of your companies, and these are the easiest companies to value with negative earnings, if that negative earnings is caused by an extraordinary charge, you can say it's extraordinary, it's not going to happen again, I'm going to act like it's not there. But here's the catch. Let's say you look across the years for your company, and you notice that every 5 years, you see a one-time charge of roughly $1 billion. Should you get a little suspicious about this being one time? Because to me, it looks like you're just bunching up your expenses and taking them as a big charge, right? Companies have become incredibly creative about doing this. In fact, UK analysts devised this term called EBBS for companies, and it's not the expansion you think it is. It's earnings before bad stuff. So here's the way the company would report earnings. Earnings before bad stuff this year was $7 billion, but we had a lot of bad stuff. And if you see bad stuff after bad stuff after bad stuff, you have to stop and say, maybe this is not bad stuff, this is part of your operations. So when you see extraordinary charges for your company, make that check. Check across time to see if you're getting one-time charges in multiple years, because it might just be gameplay. Which brings me to a related issue, and this is the question that we started with, because with earnings, for better or worse, we are working with accounting numbers, right? And we've heard stories about accounting fraud and how you can cook the books. I can't give you a magic bullet that says if this happens, because if that were true, we'd be catching fraud right away. But there's this area of accounting called forensic accounting, which is developed primarily in response to all the accounting gameplay. And the objective in forensic accounting is very simple. It's to go through financial statements with a fine-tooth comb, looking for clues that your company is not quite breaking the rules, but bending the rules. I mean, I'll give you a couple of references after class, where I'll send you a couple of references on forensic accounting books that are kind of readable, because most of them are not readable. They're written by accountants for other forensic accountants. And if you talk about subset of accountants who are even more navel-gazing than regular accountants, it's forensic accounting. So basically, I'll give you a couple of books on forensic accounting that's for the rest of us, that looks at clues that you can use to detect when a company is playing games with you. Like here's one that I find, in fact, fairly useful. You know how you have the income statement, right? You've got accrual income. And if you go to the statement of cash flows, you can actually get cash income. How? Because you start with the net income and you subtract out the working capital changes. If you see a company where accrual income consistently runs ahead of cash income, in other words, they keep reporting profits on their income statement, but their cash income is negative year after year, something strange is going on under the surface. Because the way they're doing it is that, Sunbeam did it for a few years, where they were selling inventory towards the very end of each year at discounted prices, recording it as revenues this year and showing profits, but they were not getting paid till 2, 3, 4 years down the road. So it's clues like those, accrual income being consistently higher than cash income. Effective tax rates that zigzag. Zigzag in what sense? They go from 111% to minus 33%. You're saying, that's absurd. How can that happen? Well, if you maintain two sets of books, an accounting book and a reporting book and a tax book, you can actually end up with effective tax rates jumping around. So there's a whole set of clues that if you're interested, I'll send you the list, and you can start checking off in your company whether your company is potentially a company you should be worried about in terms of accounting fraud. Because you want, if you can, you can be wary at least with the numbers you're getting from this company. Which brings me to this issue of losses. So when I asked you, how many of you are doing companies with losses, the reason I asked you that question is your job is a little more difficult than the other people in your group, right? And the reason is very simple. When you have positive earnings and you value a company and you get too low a value, there's always a number you can play with to make your value go higher, right? All you need to do is increase your growth rate and income and your problems will disappear. When you have negative income, that strategy doesn't work. So if you have a money-losing company, and I want you to think about your money-losing company and ask you this question. The question you got to ask is, why is my company losing money? And don't come back with the pat answer of, it's because my expenses exceed my income. I know that. But the question is why? Because here are the potential reasons. The first is, as I said, it can be temporary problems, a strike, a big fine, something that is specific to the year. Your problems are simple then, because all you need to do is take them out. It could be that your company is a cyclical or a commodity company and your losses are part of the cycle. So an automobile company during a recession will lose money. An oil company when oil prices are low might lose money. And there the solution is to think about what the earnings would be across the cycle. And we'll talk about this with oil companies. Across the cycle, are your earnings going to be X million dollars, and you can replace today's earnings with those normalized earnings. So those are your easy problems. If you're losing money either because of a one-time deal, temporary problem, or because of cyclicality or commodity prices, you can normalize the earnings and act like nothing's happened because your problem goes away. Here's a tougher problem. Your company is losing money because of where it is in the life cycle. What am I talking about? You're valuing LinkedIn. You're valuing Twitter. These are companies that are losing money, that have always lost money, but that by itself is just a reflection of the fact that you're catching a company that's a young company. Snapchat, if it goes public while we're in class, will be losing money. You can't normalize earnings because this is the way it should be at this stage in the life cycle. So that problem is a long-term problem. So we'll talk about what to do because the solution is going to be the same for the other two scenarios as well. Your company could be losing money because it has too much debt. It just borrowed way too much money. You can't make that problem go away quickly because you can't pay off debt when you're in trouble. So you could be losing money because of too much debt. Or your company could be losing money because of deep structural problems in the business. Like what? I mean, you're an automobile company. Your factories were all built in the 1950s. Your competition has all built more updated, more efficient factories. Your cost might be 30% higher than your competition. You can't fix this overnight. So those are structural problems. With life cycle, leverage, and structural problems, you got to map out a pathway back to profitability. You say, how the hell am I going to do that? I'll take you through a couple of companies where I will try to do that, but I'll give away my the core way of getting around this problem. You want to look at what your company's profit margins will look like once it gets past, whatever the problem is, whether it's structural, life cycle, what will my margins look like? Not an easy question to answer, right? Because I'm asking, what will Twitter's margins look like once the problems go away? And I'll give you a preview. We know there are social media companies, online advertising companies that are a little further up the life cycle that have in a sense gotten over this problem, right? Like Facebook and Google, operating margins of 25 to 30%. Will Twitter get all the way there? You might decide they might go only to 15%, but you have to pick a target margin, and that might be in year 10, and you have to coax the company back on your spreadsheet from where it is today to where you'd expect it to be. So if you have a long-term problem, don't try to make it go away by normalizing income now. You have to map out a path. And margins are probably the best number to use to kind of map out that path. So if you have a money-losing company, just think of it as a challenge that you got to overcome. The losses have to become profits. And the one thing that's always going to be at the back of your head is, what if they don't make it? Set that thought to the side while you're doing your valuation. Because after you've done your valuation, I'm going to let you bring it in by asking, what if I don't make it? So that's the earnings part. Update, normalize, clean up. You've got your earnings for the base year. Now let's talk about taxes and reinvestment. First thing to recognize is taxes are part of life. I mean, you might try to minimize them, you might try to avoid them, but your cash flow should always be after taxes, and your discount rate should be an after-tax discount rate. After corporate taxes, not your personal taxes. You're saying, why not include my, you know why I don't want you to bring your personal taxes into this equation? because we go around this rule. Our personal taxes actually are very different depending on whether you, and even within our own portfolios, our personal taxes are different if you're buying a stock for your pension fund as opposed to buying a, so personal taxes are a mess. So what we do is we do everything after corporate taxes, but before personal taxes. And the question we're going to have to face then, and this is going to show up in our cash flows, is what tax rate should I use to get to my after-tax cash flows? Now, I asked you a variant of this question when we did cost of debt, right? I said, what tax rate do you use to get your cost of debt? And there the answer always is, use the marginal tax rate, because interest saves you taxes at the margin. But this is a different question, because you're saying, what is the tax rate I pay across all of my income, not just the last dollar of income? So keep that in mind when I give you the choices, and you tell me which choice you would make, and then think through the consequences of using this that number. You could use the effective tax rate. Most companies report this, right? And effective tax rates are based on what you see in the income statement. It's the taxes, the accrual taxes in the income statement divided by accrual taxable income. You know why I'm using the word accrual? It's not a cash tax rate. It's actually an effective tax rate based on accrual taxes and accrual income. Anybody know what that number was last year across all U.S. companies? I think I gave you this number last week. It's about 25% across all tax-paying companies. If you bring in the money-losing companies, it gets to be lower, but 25% tax rate across all tax-paying companies. So I could use the effective tax rate, usually much lower than my marginal tax rate. I could compute a tax rate based on taxes paid divided by EBIT. And after all, we're in doing free cash flow to the firm. We do EBIT times 1 minus the tax rate. Why not compute a tax as a percentage of the EBIT? This number is going to be even lower than my effective tax rate, because instead of dividing by taxable income, I'm dividing by earnings before interest and taxes. That number across U.S. companies is about 15%. So you have 25%, you have a 15%. You could use the marginal tax rate, which in the U.S. is about 40%. If you're a multinational, maybe I could use a weighted average of the marginal tax rates of all the countries you operate in, because the marginal tax rate varies across countries. Maybe the answer is none of the above, in which case you better give me an answer, because I need a tax rate. Oh, this would be nice if this were true. Maybe I can use any of these tax rates as long as I stay consistent, use that tax rate all the way through. You know why that would be nice if it were true? If all I had to do was be consistent, what's the easiest tax rate to work with in valuation? A zero tax rate. I would just value every company as if it were not taxed. So clearly that answer is off the table. You have to pick a tax rate. The question I have is, which of these tax rates? Let's start with the tax rate that I get from the EBIT. It's, as I said, lower than the effective tax rate, right? Why is it lower? What makes it lower? Because in one case, I'm dividing taxes paid by EBT, earnings before taxes. In the other case, I'm dividing taxes by earnings before interest and taxes. It's lower because I have interest expenses, right? You see the problem with using that tax rate? If I use that tax rate, what am I going to do to my cash flows? I'm going to push them up because I'm getting an interest tax savings. And then I'm going to discount that cash flow back at what? A cost of capital that includes the tax benefit from debt. I'd be double counting. So cross that out, because if I do that, I'm going to end up with too little in taxes and too high a value. So it's really between effective and marginal tax rates. Cost of debt was easy. Marginal tax rate, because it's always at the margin. Here you can see that the choice is more messy because it's across all of your income. So here's what I suggest you do. You could go to the marginal tax rate right off the top if you want to be conservative, but then what are you saying about Apple? That starting today, they're going to pay 40% of their EBIT on taxes across the world. That's going to give you too low a value for most companies. So going with the marginal tax rate right off the top and just staying with it all the way through might make you feel better about being conservative, but your value is going to be too low. What if I go with the effective tax rate, 15% for Apple in perpetuity? What am I then assuming implicitly that might be troublesome? It's not just that. Right now they're holding all this income outside the U.S. because they don't want to bring it back, right? If I leave it at 15% forever, what am I saying? I'm assuming that they can keep deferring taxes forever and it never ever catches up with you. That's a dangerous assumption, because there's a padded cell in a federal penitentiary waiting for you if you think you can pull that off. So you're saying I can't use the marginal tax rate, it's going to give me too low a value. I can't use the effective tax rate all the way through because it's going to give me too high a value. So is there a compromise solution that I can use? What do you think Apple, for the next 5 years, do you think Apple can continue to do what they're doing right now for the next few years? Yeah, they've been doing it for a while. So for the next 5 years, I use a 15% tax rate. I can argue that that's okay. You got good tax lawyers. But remember, there's that perpetuity waiting for me, right? Year 10, year 15. I get to that year and I put a 15% tax rate. I'm locking in the 15% tax rate forever. So here's what I do. I start with the effective tax rate because I'm giving you the benefits of deferring taxes. But as I go through time, I'm going to move the tax rate towards your marginal tax rate. And this is the debate I'm having with myself, and I haven't really resolved it for myself. And that's the problem with debates with yourself, is you win either way, you lose either way. Is what marginal tax rate should I use for Apple in perpetuity? The first answer seems to be easy, right? You just use the US tax rate. But in a sense, Apple is a multinational, and at some point in time, you could argue that the tax rates of all countries are either going to converge or the companies are going to move towards so increase it. I used to use the 40% for all US companies on the presumption that they would want to stay US so much, or keep their US incorporation so much that they would do that. But the bigger the divergence between the US marginal tax rate and the rest of the world, the less comfortable I am making that assumption. So I actually am shooting for a 30% marginal tax rate as a global tax rate because I think that's where the US is going to end up. Because you're going to end up, if you look at where the European countries have all ended up, between 25 and 30%. And both presidential candidates are talking about lowering the corporate tax rate to somewhere around there. I mean, I think one candidate is talking about 15%, but that'll never happen in Congress. There's too much revenue you're going to lose. So I think we're going to end up around 25 to 30%. But the way Congress works is that could take 7 years to do. But 7 years is still within my time horizon, 10-year time horizon. So it's not an easy answer to give, but if somebody asks you what tax rate should I use on my cost of debt, it's always a marginal tax rate. It's 40% today. But if somebody asks you what tax rate should I use on my income, very different process for thinking through it because it's across all your income. Now NOLs are in the news, right? Of course, because last Sunday the New York Times was able to get its hands on 1995 tax returns from Donald Trump. He lost $916 million. And the problem with political journalists is their economic thinking is so primitive, it's kind of scary. I mean, there's a story here, right? How the hell do you lose $916 million? So there are stories in here, but the New York Times story actually made it seem like the NOL was some kind of a tax avoidance technique. It's part of business. If you take away 40% of my income in a good year, and you say when you lose money, you can keep all of the losses, this isn't a fair game. The nature of NOLs is assuming that they're with reasonable expenses. And so that's where the question should be. What did I put into the NOL? Is when you have an NOL across the world, this is not just in the US, you're allowed to carry it forward as a company and offset it against income. Now that might change after this election because if NOLs get tarred as bad things, who knows what Congress will do to it. But for the moment, if you have an NOL, the New York Times had an NOL in 2014. In fact, you look across businesses, there isn't a single publicly traded company that hasn't had an NOL at some point in time in its life. Because at the start, it might have been 70 years ago for some of these companies. So let's play the game as it's designed right now. Let's say you have a company that has $1 billion in net operating losses. When you read your 10K or annual report, do a very quick, one of the nice things of downloading it as a PDF file is you can search, just go into the search box and type in NOLs to see if your company, you'll be surprised at what companies are carrying over from past years. So let's say your company has $1 billion NOL coming into the analysis. Let's assume a company is expected to have operating income of $500 million every year for the next 3 years. It's a very simple problem. You don't need to pull out your calculators. My problem is about the taxes you will have to pay for each year. Ready? You got an NOL of $1 billion from previous years. Next year you make $500 million in operating income. How much are you going to pay in taxes? 0. But you've used up $500 million of NOL. You have $500 million left over in year 2. You make another $500 million, you're going to get 0. In year 3, you're going to start to pay taxes. NOLs save you taxes. So when you do your free cash flow to the firm, the easiest way and the best way to bring NOLs into your analysis is not keep them outside, but make them part of your cash flows. Track the NOL over time and use it to protect yourself against paying taxes in the years that you make money. And if you have moral or ethical problems with it, let it go. Right? This is a company, you're investing in it, you don't like NOLs. This is the way the world is structured right now. So when you have NOLs, it does add this layer of cash flow savings, and those cash flows in years 1 and 2 will be higher by $200 million in year 1. See why $200 million? If your tax rate is 40%, you would have paid $200 million in taxes in year 1 and 2. Now you've saved yourself $400 million, but it's spread out over the first 2 years, so you have a time value factor, and there's a risk factor, right? Because the income in next year and 2 years out are expected incomes. They might not be there. So by discounting them at your risk-adjusted rate, you're adjusting for time value and adjusting for the fact that you might not be able to claim your NOL because your income is not there. So, any questions about taxes? Yes? Keep going. You have to keep pushing your terminal. If you have that much NOL, you dug a hole so deep that if you, in fact, even if you push it out, I'll tell you, even before you finish your valuation is probably going to give you a really low value for your company because it's taking you that long to make the income back. It's not going to be enough income. In some businesses, though, it can last a long time. Yesterday, I got 2 calls. First was from the Washington Post, and the second was from USA Today on whether they could use the tax rates of my website in a story. And you know what tax rates I wanted to talk about? Real estate developers' tax rates. Guess what the average effective tax rate paid by real estate developers last year was across all real estate developers? It was about 1.5%. And across those real estate developers that did pay taxes, because remember, a lot of them didn't pay taxes, it was 17.5%. So what they were looking for a conspiracy angle from me and said, look, you can use whatever number you want, just don't quote me. I can't handle the toxic waste that's going to come. If my name is attached to this, then everybody on both sides is going to jump on me. But there's a reason real estate developer tax rates are low. You know why? Why is the effective tax rate still so low? It's 2008 still playing out. The losses they had in 2007 and 8 were so large that they're still there. So if you look at Toll Brothers, they're still carrying losses forward. And that tells you how long there is. It's almost 7 years later, you're still digging yourself out of the hole. Right? So it can happen, and if it does happen, go out to 15, maybe to 20 years, because you can't have an NOL in your terminal year. It'll just throw everything off. Yes?
Does it ever prescribe?
I'm sorry?
Does it ever prescribe the losses?
Oh, you mean there's a certain, it used to be in the US you could carry 7 years forward and 3 years back. But they've removed that for the simple reason that if you're not able to cover your losses within 7 years, you're probably not around in the first place, so it wasn't doing much for them. So now you can carry it forward for as long as your business stays as a going business. Any other questions about taxes? Is it 20? I'll have to check. I thought, I've never seen somebody, or at least I've not seen a company in the last decade say they have lost an NOL. So maybe the 20 is this way out enough that I'm not seeing it yet. But that'll be kind of interesting for a company to survive 20 years and not have covered an NOL. So 20 years effectively makes it forever. You're also allowed to carry it back. The people don't realize it. You're allowed to carry it back, which actually allows you to get tax credits for previous years. That's why the New York Times was able to claim a tax credit last year, even as they reported a taxable income, which is what makes your effective tax rate a negative number. So that's why you can end up with negative and positive and negative tax rates for your companies, because of this across time playing with taxes. Yes?
We haven't dealt with it at all, but you can't carry NOLs forward in state taxes.
I have no idea. It depends on the state, because state taxes, each state, I mean, you've got 50 states, I guess the only state we care about is Delaware. No, actually that's not true because your state taxes are based on where you make your income. And unfortunately, Delaware doesn't have a whole lot of people. As you can see, if you go through a train, you've missed Delaware entirely. If you fall asleep on Amtrak, where was Delaware? Back there, right? So California, it probably varies across states. Some states you probably can carry it forward, so I'm not sure. Yeah. Yes?
So these NOLs, can they potentially generate value in an acquisition? Because for the company holding them,
You got to be, see, anytime you talk about a tax reason for an acquisition, I can almost guarantee you the IRS is thinking of exactly the same thing and is trying to counter you. So the way NOLs work in acquisitions is you can't take an NOL of a target company and use it to cover income on your acquiring company. It has to be the target company. It used to be different. It used to be that you could buy companies with big NOLs. Your biggest asset was your NOL. You were the biggest loser of all time. People would pay to get the NOL. And to counter that, increasingly the IRS has made it more and more difficult for you to consolidate a company. And you might still be able to pull off some tax benefits, but you got to thread the needle. I mean, there are such strong restrictions on how NOLs can be used in M&A that if you can pull it off, it's probably because you've threaded that needle. Right? Any other questions? Now let's talk about reinvestment. The big chunk of reinvestment is net Capex, right? Capital expenditures minus depreciation. And the one thing I would caution you is you can look at this number in the past, right? So what was the Capex last year? What was the Capex 2 years ago? Depreciation last year. But don't make that your driving force of future net Capex. So what you have to think about is you have a history of your company. You have Capex, depreciation, growth. That's fine. You have a lot of history. Use it. But now you're sitting today and you're making projections for your company about the future. If you're projecting no growth for your company in the future, I don't care how much Capex this company was putting in last year, 2 years out, 3 years ago, 4 years ago. Given your projections about growth, your net Capex should be a very low number, maybe even a zero number. What I'm saying is you've got to link your net Capex assumptions going forward to your assumptions about growth, not to past net Capex. Okay? So with net Capex, you're going to see this play out with companies is I will look at last year and then I will let it go. Maybe last year is a good indication, maybe it's not, but it can't be just forecasting out Capex and depreciation. This is not financial modeling. It's telling a story about a company that makes sense. So net Capex is one chunk of reinvestment. It does require to make assumptions, but it is one slice of it. The other chunk of reinvestment, of course, is change in working capital, right? It's the line item in your free cash. Change in working capital affects your cash flows because you get accrual income, but you collect only the cash on that accrual. So change in working capital is just moving accrual income to cash income. And again, you can look at the past. And I'll give you a note of caution. Changes in working capital are the most extraordinarily volatile number of all the cash flow items. What do I mean by that? You take a company, you can get a plus 2 billion followed by a minus 3 billion followed by a plus 4. So it's all over the place simply because accounts receivable, inventory are kind of rolling numbers. So don't try to forecast out future changes in working capital based on past changes in working capital. You're saying, how the hell am I going to do it? Here's a much more effective strategy. Take your non-cash working capital as a percentage of revenue, right? That's a more stable number. So for some sectors that can be 10%, some it can be 5%, some it can be 3%. It doesn't even have to be a company. You can look at the sector. You projected out revenues, right? Based on your stories, you tell me revenues will grow 3 or 4 or 5%. Estimate your working capital based on your revenue change. It's going to give you a much more sensible, much more stable number rather than going with the changes from year to year. So let me illustrate this. Yeah. In 1999, when I wrote the first edition of Dark Side of Valuation, I'm sorry. I jumped to working capital. When I wrote the Dark Side of, I'll come back to the working capital. When I wrote the Dark Side of Valuation, 3 of the companies I looked at were Amazon, Cisco, and Motorola. And I was looking at just tech companies, 3 companies at 3 very different stages in the life cycle. So as part of the valuation for each of the companies, I looked at the revenues, I looked at the working capital. First, notice with Amazon and Cisco that the non-cash, not the change, but the non-cash working capital is a negative number. You say, how the hell can that happen? It's the difference between non-cash current assets and non-debt current liabilities. These are companies that have so much supplier credit and accounts payable that non-cash working capital has become a negative number. And that is a little tricky to deal with because now working capital is not a a drain on cash, it can actually become a source of cash. Okay? Motorola had a pretty substantial non-cash working capital. So I've computed the non-cash working capital as a percentage of revenues in the most recent year. But I had to value these companies. I had to make their forecast for the future. I didn't look at last year's change because, as you can see, last year's change in working capital is all over the place. But I still forecast out what the working capital will be in the future. So I'll lead you through the process of what I did. With Amazon, when I looked at its history, its non-cash working capital would be negative every single year. This was actually part of their operating model. In their early years, they actually used supplier credit as a source of capital. You say, how the hell do you pull this off? I mean, in the early days, Amazon was just a retail site online, right? So you go to Amazon, you'd order something, and they'd insist you pay right away. They wouldn't say you pay in 3 months. You paid right away, and they'd mail you that. But in the early years, Amazon actually was able to get 2 or 3 month periods to pay their suppliers for whatever they sold you right away. So what they did was they used that cycle as a way of raising capital. In fact, there were equity research reports in the late 90s that argued that this was the secret for Amazon's success. They'd found a way to grow with very cheap capital, supplier credit. And the story actually made sense for Amazon at that stage. It was a small company. Manufacturers were willing to give stuff to Amazon and say, you can pay in 3 months, because they wanted to be on this online retail space. But the question is, as Amazon gets bigger, can they sustain this? So to take a look at that, I looked at the entire retail business. In 1999, that was the only business I was looking at for Amazon. And the non-cash working capital for the entire retail business was 8.71%. In the traditional retail business, non-cash working capital is a drain on cash. You actually have to have inventory and accounts receivable that exceeds supplier credit. So here's what I had. Through their history, they've had negative working capital, but the business they're in requires a working capital. I had to decide whether to leave them with their traditional model, which is let supplier credit and keep doing it as they become a $100 billion company, or move them to the industry average. I actually chose a middle solution, and here's why. Amazon is a retail company. In fact, in those days, it was primarily a book retail company. I mean, that was their origin. And if you're a traditional book retailer, you have to maintain a lot of what I call show inventory. You know what show inventory is? Walk into a bookstore, it's those entire sections of the bookstore that are completely empty. Because you're supposed to have philosophy books. Nobody buys them. But if you're a bookstore, you've got to keep that whole shelf filled in, right? Because everybody's making a beeline for that middle where you've got your Harry Potter books, they pick it up and they're out of there. You have to maintain show inventory because you're a retailer. You can't have an empty store with just the stuff people are buying. Amazon doesn't need to maintain show inventory. You want to order a philosophy book, you order it on Amazon, they'll say, look, we'll get somebody to write the book. We will print it and send it to you. This will be on demand for you. So it means that they can settle, even in steady state, when they become a much bigger company, that they can end up with a much smaller So I use 3%. You're saying, why 3? Why not 2? Why not 4? Use 2 or 4. It's not going to make a huge difference. And in fact, their non-cash working capital did go from negative to positive about 8 years into their existence. They now have non-cash working capital, but it's now a much smaller percentage than the rest of the retail sector. With Cisco, the average was minus 3.16%, but this entire sector has a working capital cycle that allows them to take advantage of. So this is not just Cisco, and it's not just because they're a young growth company. This entire business seems to have a cycle that works in their favor. So with Cisco, I actually allowed working capital to stay negative. You know what that means, right? As I increase my revenue growth, they actually start to get cash flows from working capital. A positive cash flow. It actually makes the cash flows go up. And that was what I projected out through their high growth period. But once I got to steady state and made them a stable growth company, I essentially made it 0 because I didn't want this to become, I didn't want accounts payable to become an infinite number, a supplier credit to become a different number. With Motorola, their non-cash working capital in the most recent year was 8%, 8.23%. Their average over the last 5 years was 8.91%, and the average for the industry was 7%. So this was a pretty easy one. It's a 7 to 8.5%. I'm not going to be off by much. I left the number at what it was in the most recent year. So with Amazon, I chose this arbitrary number, somewhere between where they are now and where the rest of the sector is, even though it's brick and mortar. With Cisco, I chose a number that reflects where they are now for the moment, but as I went through in the future, I moved that number down towards 0, saying you can get cash flows from working capital, but at some point in time, it's not going to be a source of cash. And with Motorola, I left the number at what it was, essentially forever. 3 different rules for 3 different companies. I don't know which company is going to best fit your metric, but be flexible. There's no one rule that's going to work with every company. I skipped a few Capex pages, so let me go back to those, right? This is actually a restatement of what I talked about last session. So in yeah, go ahead. No, for Amazon, I actually left it at 3%, I think. Let's see. Yeah. Cisco, I left it at 0. No, Motorola I left it 8.23% because there the sector itself seems to operate with see, at Cisco, the entire sector seems to operate on a negative working capital cycle. It's not just Cisco. Across the board, this seems to be par for the course. That they don't maintain much. It's a software company, right? So in a sense, they don't maintain traditional inventory, and they're able to use the cycle to their advantage. So with Cisco, I allowed them to benefit from that for the near term, but not forever. With Motorola, there's a drain on the cash flows because they actually have to maintain working capital, and I left it at 8.23% forever. With Amazon, initially they have this benefit, but they're a young company, and over time I assumed it will move towards not all the way to the industry average because they're online, not brick and mortar. I moved it towards 3%.
Yeah, so you move it towards 3%. Is there any specific way that you actually do that? Do you do it like on a straight line, or do you do it?
You know what? I tried different, and the value effect was. So here's the way I decided, because in a sense, I wanted to ask myself, how much time do I want to spend on this? Because you could finesse it and get. I found that the first 3 tries I had, my value per share moved by about 20 cents per share. Whether I used straight line, whether I used exponential, whether I did fancy stuff. And I said, why am I wasting my time? It doesn't seem to move the value very much. So one thing you might want to do before you spend too much time with the working capital is change the number from 3 to 4%. See if it even affects value. If it doesn't, then in a sense, whether you use 3 or 4, you're good. So if you're within shouting distance of the number, and 9 out of 10 companies, working capital is not going to be the big assumption that drives evaluation. Maybe if you're doing a retail company, I would spend a lot of time on working capital, but in most other businesses, it's going to be a secondary effect, not a primary effect. So essentially, I moved it in straight line steps, simply because it didn't seem to make much difference how I got there, but I did get there finally. No. Any other questions? So when you talk about Capex, traditional Capex comes from statements of cash flows, but that measures land, building, equipment, what accountants call Capex. Last session, I talked about bringing in other types of Capex. In particular, we talked about R&D being Capex, customer acquisition cost being Capex, building a brand name being Capex, and we talked about how to convert R&D from an operating to a capital expense. The objective is you want to bring that number into your Capex, because if that's the way you grow is by doing R&D, I want to reflect that in your Capex number. But here's the other missing piece in Capex. There are 2 ways companies can grow. One is with internal investments, whether it's in Capex, R&D, etc. Those are all internal investments. But if you're in a hurry and you want to grow, the other way you can grow is by going out and buying another company. That's what Microsoft did, right? Its internal growth engine had kind of broken down. So what has it done? It's gone out and paid $26 billion to buy LinkedIn. This year, if you ask me to compute the free cash flow to the firm for Microsoft, I'm going to have after-tax operating income. I'm going to subtract out net Capex from the traditional statement of cash flows. I'll adjust R&D. But I also have to bring in the $26 billion that they spent on LinkedIn this year as part of their Capex. You're saying that's going to make your cash flows negative. It is the reality. This year, if you think as an investor, Microsoft, because it bought LinkedIn, is going to have negative cash flows. Is that going to be the death knell for your valuation? Not necessarily, because what do you hope to get from this LinkedIn acquisition? Higher growth, higher margin. So I'm going to give you the benefit of having LinkedIn, but your cash flows will have to reflect the cost of that acquisition. Actually, somebody from Microsoft it emailed me about this, and I said you should count it, and their counter was, but we're paying with shares, at least for some of it. Can we just count the cash part? I said, no, you've got to count for all of it, because when you pay with shares, all you're doing is skipping a step, right? You see what I mean by skipping a step? You could have issued the shares to the market and used the cash. I can't let you use a barter system to evade this process. So as you watch Twitter being in play, if Salesforce buys Twitter, I guarantee it will be a share for for share transaction. If you're doing sales force valuation, that should become part of your Capex, if that's the way you grow. If your question is how much of a difference can it make, this is an extreme example, but I used Cisco in 99. Cisco in 99 was one of those great growth stories of all time. It went from being a $4 billion company in 1990 to briefly being the largest market cap company in the world. People don't remember it, but in 1999, for a very short stretch of time, Cisco had a market cap of $400 billion. You say, how do you get from being $4 billion to $400 billion? They had a decade where they did acquisition after acquisition. Not big acquisitions, but lots of small acquisitions. So I was actually valuing Cisco in 99, and one of the questions I had to answer was how much Capex do they have? So I looked through their financial statements, and in the statement of cash flows, they told me about some acquisitions they made, but then I kept reading. And they talked about other acquisitions they were making that did not show up in the statement of cash flows. Why? Because they were using shares. In fact, in 99, there were two ways you could account for an acquisition in the US. You could use what was called pooling, where you usually paid with cash. Or you could do pooling, where you paid with stock, and purchase accounting, where you paid with cash. So all the pooling acquisitions actually didn't show up in my statement of cash flows. They were in the footnotes. I had to bring them in by looking at how many shares they used in the acquisition and what the share price was that day. Their total acquisitions just in 99 were $2.5 billion. Just to put it in perspective, when I computed the free cash flow for Cisco, they had their traditional Capex, if I believe the statement of cash flows, was $98 million. That's what the accountant told me the net Capex was. If I adjust for R&D, that adds another $1 billion, and then I bring in acquisitions, another $2.5 billion. They actually ended up investing $3.7 billion in 99, but most of it was in acquisitions. But remember, this both helps them and hurts them. It helps them by giving them the higher growth. I'm going to give them the growth, but it hurt them in terms of reinvestment. But you have to stay internal. You can't count one and not count the other. And usually when people want to count one, guess which one they want to count? They want to count the growth from acquisitions, but they don't want to count the cost. You have to bring both into your valuation. Any questions on acquisitions? Yeah.
If you're financing through stock or debt, don't you have positive cash flow from the financing portion?
Remember, cash flows from or to your claim holders don't show up as part of your cash flows. Because what you're looking at are the cash flows to the claim holder. So if I raise equity from you, it's not a cash inflow to the company because you are the equity investor in the company. I'm taking equity from you. So if I'm raising external financing, it can't make my cash flows become more positive. So if I have a negative cash flow, the way I'm covering it is by raising fresh equity. So that's the way you explain why you raised equity or issued debt, is by saying, look, I have negative cash flows because I did a big acquisition. This is the way I made up for it. So think of stock issues and debt issues as the way you cover negative cash flows, not as a source of cash flows. Okay. Any other questions? Yes?
Just on that, you have to note that amortization is included in the depreciation number. That
Right.
was
Because it says DNA, so basically, past acquisition amortization. It used to be in 99. That was a much simpler game because the way you did amortization and acquisitions is you amortized goodwill on a linear basis over, I think, a 20-year time period. Today it's become this mess called impairment, right? Which means that you could have nothing, 15 billion, right? Because the accountant writes it off. So it shows up as part of the DNA number. Okay? So that's what I mean by saying it's in that number. I don't have to do anything special on my part to bring it in. Okay. Yes?
If you divest the part of the company, does it just work in the opposite?
If you again, remember, it's about the future, right? So if it's a one-time divestiture or a one-time acquisition, you can ignore it. It's done. But if you have continuously, so if you buy something and sell something else off, and that's part of your operations, then you got to bring them both. You'd have to do the net number each year. And if you're growing, the net number could be positive. If you're shrinking, the net number can be negative. But it's really a question of, is it going to continue? Because it's not going to continue. Why bring it into your cash flows and then project it out in the future, right? So think of this as your base year in your spreadsheet. You don't want to put anything into your base year that you think is just a one-time deal. Any other questions? So now let's talk about cash flows to equity. So everything we've talked about so far is to get to cash flows to business. Started with operating income. We acted like we got tax on the operating income. You see what I mean by acted? You don't act like you have interest. So basically act as if you have no interest expenses. You subtract out net capex, including acquisitions and R&D. you subtract out the change in working capital. You got the free cash flow to the firm. This is the cash flow from which, here's all the things you have to do from it. You've got to make debt payments from it, right? Interest payments and principal payments. If you're paying dividends, it has to come out of this. If you're doing stock buybacks, it has to come out of this. So the free cash flow of the firm is what you use to cover every conceivable claim that you have on your cash flows. But let's say you want to get to free cash flow to equity. Free cash flow to the firm is a pre-debt cash flow. You want free cash flow to equity. You essentially are going to subtract out the cash flows to debt, interest payments and principal. That's as simple. It's as simple as it gets. You're saying, why would you want to get free cash flow to equity? You already know what it is. It's a dividend paid, right? And that's the basis for the old dividend discount model, which is, hey, companies generally pay out their free cash flow to equity in dividends, so we're going to trust that the dividend is the free cash flow to equity. But the key word is trust. You're assuming that managers pay out what they can afford to in dividends. Now, in corporate finance, we talked about dividend policy. We know conclusively, beyond the shadow of a doubt, that companies don't pay out what they can afford to in dividends. In fact, we know conclusively that most companies hold back cash. You know how we know that? What gives them away? If Google told you, we're paying out what we can afford to pay out, what can you show them, say you're lying? How do you get a $100 billion cash balance? It's not manna from heaven that suddenly popped up, right? It's a direct consequence of you holding back cash. That's how we know companies don't pay out what they can afford to in dividends. 80% of companies globally hold back cash. You're saying, what about the other 20? Do they pay out the right amount? No, they go the other direction. They pay out more than they can afford to, and they have good reasons. We want to maintain dividends. We don't want to send the wrong signal. You know that Deutsche was paying dividends until 2015? Why? Because they didn't want to send the wrong signal. To whom? But for whatever reason, we know that dividends and free cash flow to equity are not the same number. That's why we compute the free cash flow to equity, to get a measure of the potential dividend. So when you think about free cash flow to equity, the question is, what do I need to do? You need to start with your free cash flow of the firm and subtract out debt payments. You cannot act like earnings are free cash flow to equity. I've seen actually discounted cash flow models where net income is discounted back. And if you ask people why, they say, well, that's what you could have paid out in dividends. Technically, that's true, right? I could have paid out my net income in dividends. But what in your valuation should then show that would reflect that fact? If I pay out my net income every year as dividends, what kind of growth rate should this company have? It should have a growth rate of 0. So if you're using a growth rate of 0 and you're discounting net income, I'll back off and say, okay. But if you're using a 5% or a 10% or a 25% growth rate and you're discounting net income, then you're having your cake and eating it too, right? You're paying yourself the entire dividend, and magically you're also creating growth out of nowhere by putting no money back in the business. So when you talk about free cash flow to equity, all the rules we talked about in the context of traditional free cash flows apply, plus the fact that you now have to make debt payments. So if you think about computing free cash flow to equity, it's actually a very simple analogy to how you computed free cash flow to the firm. So remember the free cash flow to the firm computation, set it to the side, and think about what I'm doing differently here. I start with net income, as opposed to what? What did I start my free cash flow to the firm computation with? After-tax operating income. Why am I starting with net income? I want to look at income to equity investors after interest payments, so I'm moving to net income. Why am I not multiplying net income by 1 minus the tax rate? It's already subtracted out, so I don't have to do any of that stuff. I just take the net income. I subtract out net capex and change in working capital exactly the same way I would have free cash flow to the firm. So those two line items are computed exactly with the way they were with free cash flow to the firm. And then I have one final adjustment. I have debt payments to make, right? That's a cash outflow. But I can borrow money, and this is where debt issues come in. Here, whatever I borrow becomes a cash inflow because I'm thinking like an equity investor. When I take a loan, that's cash coming into the company. When I repay a loan, that's cash leaving the company. I net those two up. So if I'm repaying a lot more debt than I'm bringing in, that's going to be a negative cash flow. If I'm taking in a lot more debt than I'm retiring, it's going to be a positive. It's going to be a negative cash flow. So basically, you see a free cash flow to equity that reflects first interest expense have been taken out by using net income, and the debt cash flows have been factored in with that last line item. And if you have preferred dividends, remember that's just the pain in the neck you got to deal with. Treat it as a cash outflow because you're thinking about equity. purely from the perspective of common stockholders. So this is my free cash flow to equity. And it does require these two additional items, right? Net income instead of after-tax operating income and the debt payments. People who do LBO valuations often will compute free cash flow to equity because here it's a big item, because in an LBO, you got to repay all that debt over time. So that last line item in an LBO, when you project out across time, will be a drain on your cash flows as you repay the debt. But that's the free cash flow to equity perspective. That's 5 line items, or 4 line items. I'm going to give you a shortcut that you can use. But the shortcut will come with a cost. To use the shortcut, you've got to be willing to make an assumption. And here's the assumption I'm going to ask you to make. From this point on, are you willing to assume that a certain percentage of your reinvestment is going to come from debt? And you can see if you've decided that from now on, the right mix for you is 70% equity, 30% debt, and you're willing to stick with it, here's the shortcut I can use. Remember, you're thinking like an equity investor, right? So you start with net income, just like you did before. But then when I ask you, what's your net Capex? Rather than give me the entire net Capex, you give me only 70% of it. Why? Because 30% is going to come from debt. Say, that's not my problem anymore. The lenders take care of it. Then you take the change in non-cash working capital. Instead of subtracting the entire amount, use only 70% of that, saying, so it's a much narrower focus because you're thinking like an equity investor and saying, what do I need to come up with? That will give you the free cash flow to equity as well, but that does require that you're willing to make this assumption of a stable debt ratio over time. If you're not willing to make that assumption, then go back to the original computation that required you to compute the debt repaid and the new debt issued each year. So that is the free cash flow to equity. So I'm going to try it out in a company that, if you are in my corporate finance class, you're familiar with, Disney, right? So I think this was 1997. This is what the free cash flow to equity looked like for Disney. The net income was $1.533 billion. The net Capex was $466 million. So that's Capex minus depreciation. Working capital increased by $477 million. So the net income is given, the net Capex is given, the working capital is given. Let's assume that Disney had a stable debt ratio, 24% debt, 76% equity. And they've decided that this is going to be their debt ratio in perpetuity. Here's how the free cash flow to equity will be computed. Start with the net income, $1,533 million. I'm sorry, the net Capex was actually $612 million. $612 million times 1 minus the debt ratio, which is 24%, gives me $466 million. That is the portion of my net Capex that comes from equity. So think purely like an equity investor. You have to come up with only $466 out of the $612 million. Same thing with the working capital. My working capital went up by $477, but I have to come up with only 76% of that, $363 million. I subtract them out, I get a free cash flow to equity in 97 for Disney of $704 million. Just to give you a contrast, their actual dividends paid were $345 million. So let's say 97. You're valuing Disney and you use the dividend discount model. What are you using the dividend discount? You're using $345 million, you're discounting the dividends. Are you going to undervalue Disney or overvalue Disney with a dividend discount model? You're going to significantly undervalue it because you're missing all that cash that really belongs to you. So when you use free cash flow to equity, that's the freedom you get. You're no longer trapped by whatever the actual dividend policy is. You're saying, this is my cash flow, whether it gets paid to me or not, and I'm going to discount the free cash flow to equity. So is everybody clear on the intuition behind free cash flow to equity? And the mechanics are just messy, but just think of it as an after-debt cash flow, whereas free cash flow to the firm is a pre-debt cash flow. So I'm going to do some magic here with Disney. Free cash flow to equity right now is $704 million, right? That's assuming that their debt ratio is 24%. Let's assume that Disney says from this day on, 50% of our reinvestment is going to come from debt, only 50% is going to come from equity. What will happen to the free cash flow to equity if I fund more of my reinvestment with debt and less from equity? The free cash flow to equity is going to go up, right? Because I have to come up with less of the reinvestment. So here's the good news. I can pump up your free cash flow to equity as a firm by using more and more and more debt. Don't get too excited, though. Because part is saying, well, let's do an LBO of every firm. What's the other shoe that's waiting to drop? These are free cash flows to equity. I discount them back at the cost of equity that comes from a beta, which is a function of both the business you're in and how much you have as a debt to equity ratio, right? So here's the other shoe waiting to drop. It's true that as I go through from a lower debt ratio to a higher debt ratio, my free cash flow equity goes up. But it's also true as I go from a lower debt ratio to a higher debt ratio, my beta is going to go up, my cost of equity is going to go up. The net effect is what's going to determine the value of my equity. So kind of a generic final question to close this off. So when I increase leverage, my cash flows go up to equity investors. When I increase leverage, my cost of equity goes up. The question is, what happens to value? I'll read some statements and you tell me whether this is what you expect to happen. Increasing leverage will increase value because the cash flow effects will always dominate the risk effects. Does that make sense? If that were true, what should happen? Our optimal debt ratio for every company should become 99.99% debt. Now, we know that's overreaching. How about this one? Increasing leverage will decrease value because the risk effect will always dominate the cash flow effect. If that were true, the optimal debt ratio for every company should be 0%. Oh, how about this? What if increasing leverage will not affect value because whatever happens to my cash flows will exactly be offset by what happens to my risk? Does that sound familiar? From corporate finance, most famous theorem in corporate finance is the Malamud theorem. If you believe the Malamud theorem, that's what will happen in equity valuation. Is if you try to pump up your cash flows to equity by using more debt, the effect will be exactly offset. So in that world, the debt ratio won't matter. The value of equity will be the same no matter what your debt ratio is. I think A, B, and C are all false. A is false because it categorically pushes you to 99% debt. B is false because it pushes you to 0% debt. C is false because it basically says it doesn't matter how much you borrow. So we're revisiting an old corporate finance adage, which is some companies' debt will work to their benefit. The value of equity will go up. In fact, let me take that back. For most companies, there is a portion of the debt ratio where as they borrow money, the benefits will outweigh the costs. The value of equity will go up. But there will be a point for every company where the benefits will start to get less. That's your optimal debt ratio. It's a different way of thinking about optimal debt ratios through the free cash flow equity and cost of equity connection, rather than doing what we did in corporate finance of minimizing the cost of capital. So that was a long foray into free cash flows. Any questions about free cash flows? So the one cautionary note thing I hope you remember is when people say, I use stock, therefore it's not a cash expense. You know the pushback always should be, right? Just because you use stock, I can't give you a benefit. I've got to act like if you issue. This is why I never add back compensation. If you've noticed, a lot of equity research analysts to compute the cash flow for a firm add back stock-based compensation. They said it's not a cash flow. I paid with options or restricted stock. Won't fly here because I can't let you evade the cash flow restriction by using this. I just use shares because if I let you do that, you know what you're going to do? You're going to pay for everything with stock and claim your revenue is your cash flow. Sounds absurd, but that's exactly where we're going with companies because as analysts get lazy and add this, companies are increasingly moving to stock-based ways of paying for things, saying, hey, those analysts are so lazy, they're missing the fact that we have all these expenditures now because we made them expenditures we pay for with stock. Any questions on any aspect of cash flows? Your quiz will cover only through cash flow. So these last 10 minutes, you can go to sleep if you want, right? So let me at least set up what's coming next. Up till now, we're on comfortable ground. Discount rates we've talked about in the context of corporate finance. So you come to cost of equity, cost of capital. Cash flows come from financial statements. So you can think like an accountant, work through the mechanics. Now we're getting to the point where the rubber is going to meet the road. I'm going to talk about the future. We're going to talk about growth. And when you talk about growth, essentially the question is what the value of that growth is. So let me set the basic proposition that's going to govern how I talk about growth. Growth is not a good thing. It's not a bad thing. It's a good and a bad thing. The good side of growth is it makes your revenues and earnings go up. The bad side of growth is you have to reinvest to generate that growth. The net effect of growth is whether the good side is greater than the bad side. And I'm going to, if I get a chance, show you a graph of what percentage of companies destroy value as they grow, and it's going to be shocking. So we're not going to start with the presumption that if you say growth, I'm going to do a dance for you, because growth can be good, it can be bad, it can be neutral, and we want to separate good growth from bad growth. So if you think about ways of estimating growth, broadly speaking, there are 3 ways you can estimate growth, and only 3. The first is you can look at the past, historical growth for your company. It's unfortunately the most common way of estimating growth. A lot of valuations are just built on taking past growth and projecting it out. We're going to talk about the limitations of doing that. The second is to outsource your growth. You know what I mean by outsourcing your growth? If I ask you to value a company, to get the growth rate, you look at what analysts are projecting about for the company. And let's face it, for increasingly, maybe a third of all companies globally, you can find an analyst forecast of growth for your company, which you can plug into your valuation and say, hey, they know more about the company than I do. In some cases, it might be asking the managers of the company for the growth rate. It's one of the reasons I took issue with both Lazard and Evercore, was because they drew on management growth rates for them. You've outsourced the growth. We'll talk about the limitations of doing that, including the biases that come with it. And there's a third way of estimating growth, which is to tie growth to what the company is doing. How much it's reinvesting, how well it's reinvesting. You kind of know where I'm going to end up with on these 3 choices, but I'm going to lead you through the first 2 simply because you're going to run into people who will insist on using those approaches. So let's start with historical growth. So let's take a company. Let's take a widely followed company, Coca-Cola. Let's say let's say the assignment for the next 3 days is each of us comes back on Monday with the historic growth rate in earnings for Coca-Cola. Monday we all show up with the money. I'll wager that no 2 people in this class will be giving me the same growth rate. And here's why. When you think about historical growth, I'm going to take you through different ways. You can use an arithmetic average growth rate, where you add up 5 years of growth and divide by 5. You can look at compounded growth, so the growth rate can be very different. It can depend on what your starting point and ending point are. For a lot of companies, if you want to show really good growth for your company, make 2009 your starting year. You know why? 2009 was an abysmal year for companies. If you start with a base year that's really low, your growth rate's going to be much higher. You're saying that's cheating. Hey, people cheat all the time. And it's also going to depend on which metric. So when I say earnings, it could be earnings per share, it could be net income, it could be EBIT, it could be EBITDA. You can get very different growth rates. And finally, you're going to run into mechanical issues. If you have a year in the middle where Coca-Cola lost money, you're going to very quickly run into issues of how do I compute the growth rate in a year where my earnings went from a negative number to a positive number. So first thing I'm saying is historic growth sounds like a fact until you dig a little deeper and recognize how many choices you made that drive that number. So let's start with the first issue of arithmetic versus geometric growth rates. This is an old table from about 2000 looking at Motorola for the previous 5 years. So I took revenues, EBITDA, EBIT. Actually, if you look at my book, it has net income, earnings per share as well. If you look at the second to last column and row and the third from last row, I first report an arithmetic average. And what an arithmetic average is, I just add the 5 years of growth that I have the growth rates for and divide by 5. So that's the simple arithmetic average. Right below it, you have a geometric average. Somebody remind me how I compute a geometric average. What do I do? Take the last year and the first year. That's all I need. The middle years don't matter. I divide the last year by the first year, and I raise it to the power 1 over n, depending on how. So in this case, 1/5. Geometric average, big deal. That's inside statistics. Who cares? If you're saying in revenues, you can say, who cares? 7.08 minus versus 6.82% with revenues. When I go to EBITDA, it becomes much bigger, right? The change, 10.89. When I go to EBIT, it becomes 42 versus 4. When I went to net income, it became 60 versus 1. With earnings per share, the difference got even wider. So here's my first question. What is it that causes this divergence between arithmetic and geometric averages to expand as I go from revenues to EBITDA to EBIT to net income to earnings per share? It's actually a statistical reason. It's got nothing to do with financial statements, so don't think accounting. It's a statistical reason. What is it? The larger the deviation across time, I'll give you a very extreme example. Let's say my revenues grow at 8%, 8%, 8%, 8%, 8% every year. My arithmetic average obviously is going to be 8%. My geometric average is also going to be 8% because the standard deviation across time, I got a constant across time. The more variation there is in the numbers across time, the greater the divergence. Now do you see why as you go from revenues to EBITDA to EBIT to net income to earnings per share, you're going to get more divergence? Because your numbers get more variable the further down the income statement you go, because you got fixed costs and you got interest expenses kind of magnifying the variability. So when you talk about historic growth, especially with earnings per share, you got to be very careful because the arithmetic average and the geometric average can be hugely different numbers. And which number is a more reliable indicator? I mean, take for instance my operating income. It went from 2.6 billion to 3.2 billion. Over 5 years, I got about a 20-something% growth in income, right? But if I look at my arithmetic average growth rate, it's saying I grew 40% a year. That makes no sense, but the reason it can give you these deceptive looking numbers is you get these bounces in earnings from year to year. A geometric average growth rate is going to be a much more reliable indicator of the past than an arithmetic average. Here's the negative earnings issue. Okay? Let's make this our last slide today. You have a company, in this case Time Warner. In 1996, they had earnings per share of minus 5 cents. In 1997, their expected earnings per share is plus 25 cents. I have a very simple mechanical question. First, let me start with the intuitive question. You go from minus 5 cents to plus 25 cents. Are you moving in the right direction or the wrong direction? Hey, this is a good thing, right? Now, here's my follow-up question. What was my growth rate in 97? If I follow the mechanical rule, how do we compute growth rates? I take the change in earnings, which is 30 cents, and I divide by the earnings last year, which is minus 5 cents. My historic growth rate is minus 600%. That makes no sense, right? I've had this really good year, and you're telling me my growth rate is minus 600%. Don't cheat and say, well, I know it's good, so I'm going to make the minus a plus. That you can do that, no, but it doesn't make any sense. So people start to play mathematical games. One of the things they do is they use the higher of the two numbers as the denominator. They use absolute values rather than. Bottom line is, when you go from negative to positive, the growth rate becomes meaningless. That is the right answer to the question. I can play all the math games I want around this number, but I'm learning very little about percentage growth rate. I'm learning something about direction. I'm moving in the right direction. I'm learning very little about percentage growth rates when I go negative to positive. So let's stop there. We will start with a quiz next Monday and then continue with growth. Yes.
How you doing?
Good.
I should have asked you during class, but I was too timid. But let's just figure you wrote a real estate asset. But it was worth $1 billion. So it comes out of your cash flow, free cash flow starts to come out of your cash flow, and it may also be diluting when you divide by your share. Now you have a higher share base, so basically your value is less of that. Then it's value.
The last year already happened. We raised the revenue level. We raised the share. We raised the revenue level. We bought a business for a decade, right? So when I compute my average share, I know the number of shares. The number of shares is already higher because we per share. The cash flow from last year would be negative because we bought this business.
So this year or next year? This already happened, right? Or you expect that?
This will be expected.
Okay, expected next year the shares haven't been issued yet. So the way to start off is you start projecting the cash flow. You don't start with the equity issue and then go to the cash flow. You're making the equity issue because you know you're going to be short cash flow. Because if you have $1 billion already coming from your operations, you don't need to issue the shares, right? So hold off on whether you're going to issue shares or borrow money until you can do the cash flow. So you say, next year's after-tax operating income, you subtract Capex, you subtract taking working capital, you subtract out the acquisition you plan to make. You say, oh my God, I have a free cash flow to make a minus of $1. So you know you're going to have a cash flow. Which means you got to raise capital. Then you got to decide whether you want to raise the capital by issuing new shares, or you can.
So in this case, we would raise a new share.
So that doesn't even affect the valuation because the cash flow is going to be negative. The fact that you issue new shares in the future can't change your share count today. Remember, your value today is your share count today. But your debt ratio might now get readjusted because you made a capital structure. So where it shows up is through your cost of capital and capital structure. So if you told me you're going to borrow the entire billion, I said that's not a problem. It doesn't affect your cash flows, but make sure you adjust your levered rate and your cost of equity and your cost of capital because you told me something about what you plan to do with your debt ratio. So how you fund that free cash flow is going to show up through the debt ratio using the cost of capital. But the share count today is the share count today. You can't preemptively count future equity. Hi, how are you?
Good. So the company I'm valuing is in a very complex structure.
So everybody know what's carried forward?
So we have about 80 million in NOLs, and it's going to
What's your typical operating income per year?
The,
still losing
parent,
money?
for the parent company? Yeah, still losing money for the...
So your NOLs would build up even further. So you have an NOL that will actually become more negative.
subsidiary this is one of the businesses that's positive income.
And you can
So it's
offset-
about-
you can
so it's
offset
about
that
$1 million,
income to your-
$1 million a year of
Okay.
income and 80 million of NOLs.
That NOL might never run out.
So should we use the pre-tax cost of debt and then just assume no tax? Okay, that's what I
Yes. Here's what I would do though, because it'll take you 30, 40, 50 years to get to it. When you get to the end of your 10, you still have an NOL. But when you do your terminal value, act like you're paying a 40% tax. But you might have a remaining NOL of 30 million. Just set it to the side. Do your terminal value with taxes. And once you got the terminal value with taxes,